Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to our latest episode of the Credit Clubhouse podcast. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Kanav Kalia, Chief Sales and Marketing Officer at Oxane Partners. Kanav, thank you very much for your time. Looking forward to our conversation.
Absolutely. Pleasure to be with you, Todd. Thank you so much for having me.
So if we think about the private credit market today, kind of what would you say are the developments that make the next phase feel materially different from maybe where we've been in private credit?
Great. So it's a very interesting time, in the market, Todd, if I can say that, the private credit market has grown exponentially over the last, 15 odd years, after the GFC. And I think now it stands at a, inflection point. A lot's happening in the market, both positive, negative, some concerns also, that were voiced in the last, few quarters or so. Nothing out of the ordinary, I think, the way we see it. But I think the way the market has evolved is really phenomenal. We see that, it is going to continue to grow, of course, with some blips, etc., that we've seen in the recent, quarters or so. But the overall development, that stands out is, the overall definition essentially of credit has expanded now.
Yeah.
So earlier it used to be just, sponsored companies, who are looking for, funding. These are like, the middle market companies which are driving the American economy, but also I think the global economy, so to speak. And now the definition is expanded. So anything within the credit spectrum is what we are now considering the private credit, market. To make the distinction, we call it like the private credit plus market to
Got
essentially
it.
differentiate it from the core direct lending market. So, and some people call it like asset-based finance, some people call it like specialty lending. But the key development that has really happened in the last decade and a half is the market is being looked in a slightly broader fashion rather than the narrow sense of direct lending. So that's the key development that I like to highlight.
And what is driving some of this, the broadening opportunity? You obviously referenced ABF, there's infrastructure, CRE, securitized products, fund finance. Everything is seemingly making up private credit plus these days. Kind of what's driving the broadening of the opportunity?
Again, there are multiple elements to it, Todd. It's actually a good question, to go back, into, what's actually really driving, all of this growth and why are investments, flowing into non-direct lending investments. The core idea here is the multiple forces which are pushing it, So private credit, the core direct lending, corporate credit direct lending has been growing for the last, decade and a half or so. And it's obviously now a slightly crowded market. A lot of players, ventured into this, and it's difficult to sort of really, find interesting opportunities. And more importantly, if you look at it from a borrower's point of view, earlier they were looking at, just as an avenue of working either with the bank or then the non-bank lenders, came into the play
Yeah.
after the GFC. Now what they're saying is, look, we also have a lot of collateral. We also have a lot of contractual cash flows, which are sitting, within our firm. And can we utilize that to unlock, more value for, our firm? So that is what is, a key factor that is driving from a borrower's point of view. If you think about it, they are wanting to utilize the underlying collateral that they're sitting on. They're looking at the contractual cash flows. Now think of it from a lender's point of view. Institutions, who are investing, who are providing leverage, to these institutions, rather than just being part of providing them a core, term loan, or a direct lending situation. They are looking at, broadening the market, structuring the transaction a bit more, closely, so that, they have wider control, they have wider, safety nets, so to speak. And
Mhm.
also then that it aligns, with higher yields that they can get than they can do in a comparable, market with regards to direct lending. So multiple factors in play. Overcrowded, market, so to speak, in the direct lending market, which is where these larger institutions, they have the wherewithal to go deeper into the underlying collateral, right? Look at it closely, and say that, look, we would want to be, in a bit more sort of really a secured position, and that contractual cash flows that these institutions, they can build that into like an ABL structure that is, accelerating, the market a lot. Another interesting element that is driving the growth, Todd, is also that the LPs are getting, involved in the private credit market in the last, decade or so. And
Yeah.
when, limited partners get involved, they need a bit more rating based approach, right? They would want to know that, okay, look, these are like secure investments where, they can invest in, let's say, AAA or AA, rated investments. And, the ability for institutions to apply those tranches, apply those ratings is a lot more easier on these, asset-based finance structures or ABF structures or specialty lending structures. So there's a lot of interplay, from market expectations point of view, investors getting involved, how our borrowers looking at it, which is all contributing, to the growth of, this broader asset-based finance market.
You obviously referenced the investors there. I mean, investors see this huge opportunity, 45 trillion, 20 trillion, whatever the actual number is. But, how do they think about it in more practical terms than just that wide, scalable, oh my God, this market is so big. How do they think about it in, all right, what do we practically do in this space?
Yeah, I think the way to kind of really, think about when you think of from an investor's point of view. I mean, their core idea is, they've been, let's say, doing these, direct lending loans or core private credit, so to speak. It getting crowded, the yields are getting compressed, and obviously they're looking for higher and higher yields. Now, where do they go? And their idea is, are there related opportunities where they can leverage upon the skills that they have currently or the origination challenge that they have currently to look at, adjacent markets. And that's how I think, the ABF market, came into being. They are all kind of, they effectively, if you think about it, at a very basic principle level, Todd, these are all credit markets. So there's nothing, which contradicts, the credit fundamentals on basic principles, first principles, whether this is direct lending or asset-based finance, or you talk about, let's say, commercial real estate lending or securitized products or infrastructure, or fund finance also.
Yeah.
All of these at a fundamental level, these are like, credit transactions. There is a credit risk, involved. There's a counterparty risk, etc. involved, market risk, etc. involved, but these are all like credit transactions. And the fundamental reason is institutions looking to expand just beyond, the direct lending or the core corporate credit direct lending, space, to diversify, their investments, to look at, higher yield opportunities. And also this is driven by, where the investors, want it to be. So it is just about the skill set remains the same. It's just that, you need to create like an operational infrastructure to be able to manage a different type of investment, a different type of credit investment, so to speak. The fundamentals essentially still remain the same.
Yeah.
And if any firm is kind of, doing, let's say, or are in the credit markets, they have the, need or sort of really, interest to expand into their other, related asset classes. That's, I think, what is, fundamentally what's happening in the market.
So, you guys recently ran a survey, the Compass 2026 survey. Before we jumping into that, maybe just tell us a little bit more about Oxane. What do you guys do? Where do you cover? Where do you fit within this obviously ever expanding, ever changing market?
Yeah, so I think I'll give you a little background history about, the firm. So the firm, Todd, was founded by, ex-bankers, so to speak. So, the senior team comes from banking background. So which is why we understand the market really inside out. We've been on the
Yeah.
other side of the table. We know how credit markets operate, and all of us, I think, by the way, they are all like credit experts. So there's hardly anybody who kind of, is outside, the credit markets. Right from, the senior folks, to some of the folks, I think at the middle layer as well. When we set up the firm about 12 years ago, our idea was very simple that, look, we collectively have experience in the credit markets. There are folks, who worked at, large consulting firms. There are folks that we have in a team who worked on technology, institutions in the credit markets. So we want to combine all of that, to carve out, a firm that we felt could address the challenges, the growing challenges that we anticipated the credit markets are going to experience. Truth be told, Todd, we never anticipated that the market is going to grow so much in the last 12 years.
Yeah.
All we thought was, okay, look, we understand credit, we can solve some of those challenges because we face those challenges, firsthand, when we were on the other side of the table. And we felt, okay, look, we'll solve some of those challenges and it'll be a good journey. I think the last 12 years have been phenomenal, driven by various factors. Now, what we do is, we work with the credit only institutions. Now, these could be private debt institutions, or
Hmm.
these could be banks. When I say banks, I mean the financing arms of the banks which are sitting typically in the global markets, or it could even be like, institutional investors like, sovereign wealth funds and pension funds and so on and so forth, but everybody
Yeah.
in the credit markets. Our goal idea is we've created, this unique operating platform, which is what we call Oxane Panorama, that we deploy for these institutions depending upon each and every asset class that they are in helping them solve their operational challenges, helping them streamline their investment operations, right from the time when the deal gets closed to, helping them monitor their transactions, look at, collateral, look at, surveillance of those collateral performing, valuations and so on and so forth. So that's the whole idea, I think, right? So, to summarize it, we are a tech-based firm, which essentially is solving the credit challenges that institutions, face, in their investment life cycle, and we overlay it, with a team of domain experts, which is what we call our platform into people approach.
So you recently ran this survey. I think it was about 380 or so senior leaders in the space. Um, investment outlook, operational and tech landscape, AI. What did you find with this survey? Kind of what stood out from the findings?
Absolutely. I think let me give you a little bit background about the Compass survey. So first of all, this is one of the first of its kind survey at that scale. So this is not a survey where we kind of checking into the private equity firms, or we are checking into sort of really other related elements or alternative
Yeah.
credit, so to speak. This is only a credit only survey. And anybody who is operating within the credit markets, whether these are like large private debt institutions or these are like banks who are working in the credit markets, or sovereign wealth fund sector. So these are the respondents the survey. The coverage was global. A lot of obviously it is captured within the North American market and the EMEA market, but there's some
Yeah.
element of APAC as well, reflecting the size of the opportunities accordingly. So we surveyed about 380 odd participants, as we said, and some of the results were honestly like an eye opener for us as well. We never anticipated, which is always good, I think, right? That's the whole idea of doing a survey, to get
Yeah.
to get educated, to understand, I think, right, what the institutions are seeing. The first key highlight, was what the first question that you asked, and that became very, very evident, in the survey. So two out of the three respondents, highlighted that they are aggressively investing more and more in asset-based finance than in core corporate direct lending. So they are either very active in the asset based finance market, or they have already started sort of plans put in motion to actively participate. So that was like a big sort of really a surprise. We were still anticipating that direct lending is going to be a lion's share, but the way institutions have responded, they're saying, look, two out of every three, ABF is probably bigger than direct lending. Now, there are a couple of other findings also that I would like to highlight, just the top highlights, to align. The last couple of quarters, the credit markets have seen a few of a negative chatter in terms of some redemptions, some fraud cases and so on and so forth. Now,
Yeah.
despite that, 83%, an overwhelming 83% of the respondents, and these are all, by the way, credit participants, people who have been in the market, 83% of them said that they expect the AUM to grow, the assets under management to grow in the next 12 to 18 months. So, which again is a strong signal that yes, there are sort of certain hiccups in the market, but these are by no means systemic. They are by
Yeah.
no means sort of really, full stop. This is more like a pause, right? Where people are kind of really readjusting their priorities operationally, etc., and looking to kind of align this. Two other elements, which really stood out, for us were which I like to highlight is first is the talks around AI. I think in today's world, any conversation that you bring in, you
Yep.
can't have a conversation unless AI is at the top and center of it. Here again, I think we were slightly surprised in terms of the responses that we got. So an overwhelming like 72% of the respondents said that they are either already doing some workflows in AI or they have aggressively started to do some pilots, etc. Which means AI is kind of really really real now. It's moved away from just being talks to actual implementation, which is again like a pleasant surprise, for us if you think about it. And the last one was the biggest challenge, which I was expecting, honestly, so to speak, is risk management. And valuations have come out, as the number one operational challenge for a lot of institutions. It's also got to do with the fact, George, that, considering where the market sector is, what's happening in the market, and that is, I believe, dictating some of those responses. But firms have overwhelmingly said that look, their number one challenge is overall risk management, and how do they control sort of really the valuation operations. So these are like some of the other um, interesting key takeaways that we got from the survey. Again, there are a few others as well, but these were like really the top four, I would say, in our view, that really stood out.
And just to the audience listening, we'll link to the survey in the show notes. So please do check out the full survey. I think you'll find the information to be quite interesting. So, when thinking about a theme that not only obviously you referenced there, risk management, but has come up in conversations like this, come up at some of the events that we run, is selectivity and downside protection have kind of become top of mind for people. And so I'm curious, why do you think this discipline at origination is becoming what seemingly is an even more important differentiator once again?
Right. Again, I think yeah, that's a good question actually. Todd, considering what's happening in the market per se. So downside protection, risk management, surveillance of the underlying collateral, etc. Typically, it used to be sort of the way the market, used to work was okay. Look, there's a lot of due diligence that happens at the beginning of the transaction. So when you're entering a transaction at origination, you would perform your due diligence and checks and balances. Once obviously, there's too much money flowing after like too few deals, so you try and cut corners at origination. You probably don't do as in-depth a due diligence that you would have ideally like to do. Now that obviously has caused like certain issues as well in the market. Again, a couple of use cases that have come through with with fraud and double pledging. Now that
Yep.
again, we don't see that as a systemic risk. That okay, look, yes, there are a few cases here and there, but what's happened is there's been a realization internally across firms that the origination standards probably got loosened along the way. The deals were not done with the right due diligence controls in mind, and that was also again a function of like really cutting corners a little bit, and again too many transactions in play. And now what's happening is firms are putting this right in the center. They're saying we need to tighten our underwriting controls, we need to tighten the due diligence process that we're running, and they're going a bit digging deeper as well. So not just at the underwriting stage, a lot of clients that we work with, now they're coming back to us and say, look, we've done this deal 6 months ago. Okay, you folks are helping us monitor it, but we want to deep dive on further doing due diligence on these transactions, keeping a close eye on what's happening on these trades, maybe for market sources, etc. So they are performing like a point in time exercise now on a very rigorous basis. Now, what is the intent? The intent is so they can proactively figure out, if there are any anomalies, if there are any issues in the data, if there are, let's say, fraudulent cases, and they can, figure that out, from within the data sources. So that is what is, facilitating the, progression of these, rigorous, in-depth due diligence, needs from the firms. So all they want to do is reduce the probability of them getting hit by some of these, cases, whether these are like double pledging issues or let's say, collateral going south or, fraud being happening, etc. So that's, I think, what is really changing. And it's, I think, a positive change, honestly, so to speak. The
Yeah.
way we think about it is it's a sign of, maturing market. Folks are kind of realizing that, look, when you're investing in these transactions, you need to be aware where your ultimate risk is sitting. You need to have like proper control, and obviously that translates into having the right kind of operating infrastructure and the technology infrastructure in place. So I think in a way it's a good wake up call, for for the industry, and it's supposed to be seen in a positive light, the way we see it.
As someone with a banking background, how do you see the evolution of banks in this space? Obviously, pre-GFC, banks did most of this type
Correct.
of lending. Now, non-banks have stepped into the role, but banks have taken on a bit more of a nuanced role. They provide capital to a lot of these funds. They
Mhm.
obviously are big in fund finance, so it's a bit more of a gray area than just banks are or are not in this market.
Well, that's that. Yeah, that exactly. I think, I wouldn't have put it in a better way in terms of the question here, Todd. Yes, I think the misconception here is, look, banks are taking a back seat after the GFC. Well, that's not particularly true. Yes, there's been retrenchment, from a banks, from a direct lending point of view, from being very active in this space, directly. Again, driven by regulatory pressure, driven by sort of really, capital controls that they need to have in place. They become like too big, institutions, to fail. So, but it's wrong to say that banks have taken a completely backseat. That's actually not true. What banks are doing is they're taking a slightly different piece of the puzzle here. So they're taking a slightly different piece of the tranche, and they're sitting into the senior piece now. They're still very actively involved in the market. Now the non-bank specialty lenders are doing these direct lending transactions or asset-based structures, and banks are partnering up with them and providing them back leverage on top of it. So they're still actively involved. So what we call it is, they're not retrenched. They basically retranche themselves to the senior piece. So they're still very, very actively involved in the process per se. In addition to that, they are also forging strong partnerships, with some of these
Yep.
managers, right? A lot of these are like, obviously out in the public as well. Citigroup, and Apollo, they announced something, last year, Barclays and EGL, UBS and General Atlantic. So they're trying to sort of work together where banks know, okay, look, they have the strong origination channels. The managers, the direct lending funds, they have their strong execution capabilities. They can move at a faster speed. They can structure the transactions a lot quicker and provide the capital as well. So they're working together as well, in so to speak. So banks are still very actively involved. And the last bit is, the banks also don't want to really let go of, this full lending piece, in that manner. So some of these larger institutions have also set up their own asset management firms,
Yeah.
and they're performing what banks are doing. So taking on external capital, and competing, with direct lending funds, or private debt funds as well. So it's a complex sort of really, way on how sort of they are involved. They are still very actively involved. I mean,
Yeah.
bank lending to just to quote a number, I think bank lending to non-bank lenders has grown like 5 times in the last decade. So that just so to speak, gives you an indication that banks are a critical piece. I mean, the way we see it, we work with both these counterparties. We work with
Yep.
banks, the 20 of the top 30 institutions is who we support globally, and then 15 of the top 30 private debt funds is who we are supporting. We see that they are very actively involved. They're trying to collaborate, they're trying to kind of compete as well in certain instances. But both these institutions are like very, very actively involved from that perspective.
We've talked a bit about ABF. You referenced obviously the survey results for ABF. Even before that, in our kind of kickoff to the episode, we talked about the growth of ABF. As more capital enters that space, what are some of the operational or underwriting challenges that become a bit harder to manage when you hit scale?
Yeah, I think that's yeah. Look, so basically, I think when you enter into these, let me give you a little background. I think, right, on how sort of to think about these operational challenges.
Yeah.
So we've established that look, firms are now moving away from core corporate direct lending to some of these related asset classes, whether these are, let's say, asset-based finance, or infrastructure finance, or fund finance, and so to speak. I think there are multiple sort of these asset classes. Now, the point to bear in mind is that as you're moving away from these simple asset classes to slightly more nuanced like asset-based structures, the complexity increases.
Hmm.
It's a given, right? A term loan, to a middle market company is very different from an asset-based structure or a specialty lender, right? Which is financing, let's say, BNPL kind of a loan, or, more granular transactions. So the
Yeah.
complexity increases. Now, as the complexity increases, it is obviously given that the operational needs, the infrastructure that it is required, to scale that transaction or strategy, it will increase as well. So it has also come out, I think, right in the survey that firms are being extremely perceptive of this, and an overwhelming 86% of the firms in the survey, or respondents in the survey, they have highlighted that they plan to, or they are already in the process of sort of really increasing their tech budgets. And again, the reason they're increasing is because as the complexity of these transactions are increasing, the ability for those institutions to manage it operationally becomes like very, very important. It's not just like plain corporate direct lending now. These are like more nuanced. So as complexity increases, the expansion can only be sustained if you have the strong operational infrastructure in place. If you don't have that operational infrastructure in place, you're going to scale it up a little bit and then it'll all tumbling down. You won't be like in
Yep.
control of your risk management perspective. So I think that has come out very, very strongly, which we were I think expecting as well, so to speak. It is also coming to a level, Todd, now where firms are thinking about technology even before they are setting up these strategies. Now, this is we've seen that firsthand in the last two odd years or so.
Is that one of the bigger recent changes that they're
This is
thinking
the
of
one of the
technology first?
Correct. This has been one of the recent changes that has happened in the last 2.5 years or so. Earlier, the decade before that, Todd, the way it used to happen was we used to engage with institutions, and they used to be like, okay, look, yeah, we are going to build the strategy, we're going to scale up the book a little bit, and then obviously we'll think about, tech or operations and so on and so forth.
Yeah.
Now it's actually the reverse. So
Hmm.
people are saying, look, we are wanting to go out about this strategy, even if it's let's say 2 billion fund, 3 billion, 5 billion fund. We want to set up the operational infrastructure beforehand. Why? Because then we don't want to bother about your scalability issues, and we don't have control over the books. You're going to continue to originate more transactions while you don't even know, I think, that how you're managing the current book. And with the news in the market around the risk management valuations becoming the center of the discussions these days, it has become more and more important. So that is a very visible change that we've seen in the last 2 years. Another important aspect on why this has become important is the challenges around when you venture into these multi-strategy transactions. So you were doing, let's say, co-part direct lending. Now you're doing like asset-based finance. You also want to do fund finance. It
Yeah.
becomes very, very critical that you have a solution which is holistically able to cut across all these strategies. So the interoperability of a solution is important right on day one. If you don't do that, look, scalability become an issue. So we've seen that and it's a good change. It's a good welcome change where firms are kind of really setting the infrastructure first. Once you set up the right infrastructure, then there is no stopping you. You can kind of really scale up super easy.
I mean, how big is the risk for a private credit platform with a system that is disconnected, or hey, we'll do this system for this segment, or this system for this segment? I mean, it could create a whole host of issues from reconciliation to data normalization, right? I mean, the disconnected issues within a firm can create a whole host of problems.
Absolutely, absolutely. This is one of the strongest point I think, right? Especially for multi-strategy funds, on how do you really think about bringing everything together. And if you have like multiple systems, or you don't have systems, you're running some in systems, some you're running manually. The interoperability becomes a very, very big challenge. In fact, I think in the survey as well, we had these parameters taught, where
Hmm.
we asked our respondents to outline what are the important bits, what are the important criteria when they're selecting a solutions provider. And interoperability was selected by 78% of the respondents. So they said 78% of those respondents
There
said
you go.
interoperability is very important, for the scalability of the solution. And I think it's not just about risk from a point of view of how your investments are going to go. It is also taught that you're going to lose to your peers or competitors
Yeah.
if you don't set it up. It's basically an opportunity cost, for you. You're going to lose. It's highly competitive market, and you will potentially lose to some of the other players, who are better set, to scale this up.
You're also, I would think, given some conversations I've had and obviously talking to LPs, the expectations from LPs are also changing around reporting and transparency and data access. So it's not only the strategy within the firm, but ultimately your investors who you report to are also starting to ask different questions and expect different things, right?
Absolutely, absolutely. Spot on. I think LPs are asking LPs as well as look regulators as well. I would put both of them as
Got
external
it.
external factors, because obviously you're the firm and then you have your investors, which are LPs, which are like the core part of your plan. But I think the regulators are also putting like pressure, and especially to some of these banking institutions, and they are forcing them to. Earlier they used to be like quarterly updates, so quarterly investor report, and you're kind of good to go. I think now they are forcing, institutions to think about, continuous, data-driven transparency and, all the other good things that come with. They want like more transparency. They want like, more frequent reporting. In fact, I think we've personally seen that when you have like a strong tech infrastructure in place, you actually are in a better position to be in the good books of your LPs and regulators, because you can then showcase very proactively when you are even fundraising. And some of our clients have
Yeah.
actually done that. They use a tool, while they use a tool for risk management, portfolio management, but they utilize it to showcase it to their prospective investors as well, as a means to showcase the level of the maturity of the organization that they have from a tech point of view. And that goes a long way, because that gives the LPs a lot of confidence. That gives them a lot of trust that, okay, look, there's an independent solution we put in place. And I think now, with the market is, more money flowing in, yes, LPs are kind of, really, making it very, very clear to the investors that look, they want like, more auditable, more transparent, more frequent information from a risk management, even from valuation point of view. So that's I think, absolutely what's happening in the market. And again, that's driving, some of these, tech initiatives, at investment firms.
Speaking of technology, AI, you can't talk about technology these days without talking about AI.
Yeah,
And it feels like 2 years ago, there was more of this transformational conversation around AI. But it feels, and I think you've seen this based on your survey results, that it's becoming a bit more, hey, we can use AI for this improvement with the workflow or this
correct.
targeted area, versus it's going to transform everything. Is that a healthier evolution, and what did you see within the survey related to AI?
Well, I think yeah, it's honestly it's a very tough question to answer whether this is a healthy evolution or not. Todd, look, AI is a sensitive topic, I think, right? There are a lot
Yeah,
of, I think, right, camps here, so to speak, whether this is good for humanity or not. I think, I'm not going to go into the morality of, the argument here. It's very tough to answer, honestly. I think
yeah.
only time will tell, but I'll tell you sort of really, what we're seeing in the market. I already highlighted, in the conversation earlier that 87% of our respondents said that, either they are actively trialing, actively working on AI projects or AI
Hmm.
initiatives, or they've already started to do it, on one or two of the workflows. So that's a very, very strong, respondent set. 87% is almost like, overwhelming majority. There are hardly any, I think, right, who are not doing
Yeah.
anything. Now, if you drill down a little bit, I think, right, there are, which makes us believe that look, AI is here to stay. That's the first thing. We got to make it. We got to let it settle down, and make peace with the fact that look, AI is not going away. We've already shot the arrow. The genie's out of the bottle. It's very difficult to put it back in.
That's for
Now
sure.
the only question is, okay, look, what do you do about it?
Yeah.
Now we've seen sort of practical use cases. Everybody is talking about, look, we can ingest that data automatically. We can extract, information from documents. I mean, those are like very, very basic use cases. We are
Yeah.
also doing it. Other institutions also doing it. In the data extraction piece, I think the challenge, Todd, the way we see it is not about extracting information. It is about how do you make sure that the user can trust the information that you've extracted.
Yeah.
That I think is a challenge. This is where I think, right, we've done some work, with some of our clients where we are facilitating that transparency so that, even if the AI tool is extracting the information, how do we give them the comfort that it is accurate? There's no hallucination, there's no wrong sort of extraction, etc. So that's number one. There are a few other areas, so to speak, where institutions are really looking at workflow, etc. It's a given again. You can automate some workflows, etc. But there are three specific areas, that we feel where we are seeing actively in our clients getting very active in the AI space. One is around like, due diligence we spoke about. So they're actively utilizing AI or machine learning algorithms to talk about how they can further strengthen their due diligence, risk management, KYC procedures that will help them uncover anomalies. So that's one. The second is they look at like tons and tons of these like credit memos and term sheets and document preparation, etc. How can they utilize like AI, right? Because this is again a repeatable process. They can put in, let's say, hundreds of term sheets or IC memos and come up with like a thesis. So that is
Hmm.
something that we're starting to see as well. And the third very interesting use case is, which is an agentic AI use case, very early in the development, but we've seen some of the institutions do this, is when they're looking at an investment. So there's an investment committee, yeah. So the investment committee is comprising of, let's say, senior stakeholders, who are, analyzing the transaction, looking at the data. Some of the firms are also now going about and saying that, look, in the investment committee, we're going to put an agent as well. Why? Because look, agent will have access to all the historical transactions. The agent will be able to look at the current document, etc. So they are giving a AI agent a seat at the IC table, which is again transformational if you think about it.
Yeah.
So they're getting the views, they're getting like an agent who's kind of continuously working on these data. So these interesting use cases are further developing. It's still early days within the financial services world, but the feelers that we're getting or the indications that we're getting, and especially after this survey, I think it's opened up our thoughts as well, that look, this is kind of very very real, and institutions are seriously pushing through the agenda, not just on the tech space. Lots happening on the tech, right? All these large tech firms, Microsoft and Google and Anthropic and Facebook, etc. Look, they're changing their entire way of working, but that effect is also going to be seen soon enough, I think, right? In the financial services world, and then active folks are on our industry are also actively looking at utilizing the benefits like of AI. So it's quite evident now.
So if we start to look ahead in the market, what do you think will ultimately define winning private credit platforms over the next decade, or even longer? I mean, what is the core thing that you look at and say, all right, this is the winning the winning piece for private credit platforms as we go through private credit plus as we've been talking about.
Yeah, I think yeah. Look, I think the way if I were to take a call in terms of, okay, look, who are the institutions who are going to win this race or battle. They're the ones who are going to be very intentional with their setting up their operating infrastructure in place. It's actually a given now. Again, everybody is thinking about it, thought. Now I think it's become
Yep.
very very evident, as I think the numbers that I highlighted on the survey on how many respondents talk about increasing the tech budget. That's all given. The intent is there, but can you put that intent into action? Can you set up like an institutional practice in place where your infrastructure is right there, you are, and what we call it is like control at scale. So you're scaling up, but you're not losing control.
Yeah.
You're rising with strong controls. We're rising with strong sort of hooks to the ground. And and another key element that we feel is going to distinguish uh, whether AI, how AI is going to be involved, etc., tech, etc., is also going to be about the expertise of the domain, and how do you really overlay the tech pieces that you have with a team of like strong credit analysts. I think that is absolutely a strong indicator. If you're doing that and you bring in the combination, I think you'll be unstoppable, because you will have set up an ideal combination of what we call it like platform into people approach, a strong platform from day one, that can help you scale up, but also a team that can add that qualitative layer, that can add that subjectivity, that can bring in their experience, working on these transactions. I think those bits, we feel, are extremely, going to be important, in separating the winners, from the losers in terms of, when you try to, scale up, the private credit platform.
One, we have a couple of fun questions to end, but
Sure.
one side question before, like, do you think we'll eventually get to the point where someone tries to build an asset manager that is kind of like AI driven? You'd have to think at some point someone's going to try it, right?
Oh, absolutely. Look, what's currently happening in the market is, some of these asset managers, even some of the banks, they're kind of investing in firms who are doing this. Again, the reason I think, the way they're doing it is, they want to be part of the journey. If
Yeah.
let's say something is happening in the industry in the front of AI, etc., they want to be sort of really, be part of that, the firm, etc. It's unlikely, as of now, thought to for them to kind of really move away from their core business to start to build something, on this front. Again, some of the firms have done that, right? BlackRock is probably a perfect example. They do all of these investments. They have their own platform as well. So, but probably I think that's one firm that is like an exception, so to speak. Uh, Others they haven't done it. I think again the reason being economically, it is better for you to work with the experts, who've already done this and who've done it, for multiple players, and they can bring in and synthesize all of those best practices and learnings, for your benefit. I think that trend is going to remain. I think, we feel investment firms, banks, they're best placed to do what they do best, which is kind of
Yeah.
do these transactions and manage the risk and so on and so forth, and leave the, the tech and the operational infrastructure to institutions, who are best placed, and again, we for example work with other institutions. If an institutional manager were to take all of this internal, they'll have their own view, just their view, but we will bring in the expertise of like in working with 100 institutions. So I think that distinction is quite evident, and then it's economically faster for us, better for us to deploy our institutions to rely upon external service providers.
So we have just a couple minutes left. I always like to end the episodes with some fun questions. Favorite sports team or hobby?
Well, look, I think, I have had my formative education, taught back in India, and I think you're not an Indian if you don't play cricket, right? So,
Yeah, that's what
it's
I've heard.
it's a given. It's a given. But I played cricket, at my varsity level, so I think pretty excited about it. In fact, I think if I wasn't in this profession, my second profession would have been, or my alternative was, to go into sports. So
Wow.
I was really good into athletics, during my college days. So obviously, I think you take a path and then you still think about it, which is why I highlighted, right, that I still want to, given the time, I
Yeah.
still want to pick up baseball, as a sport.
One surprising thing about yourself.
Uh, One surprising thing about myself, look, people who kind of, work with me, I bring in a lot of, I think, um, you know, you know, enthusiasm and energy to sort of really in my interactions, etc. I think that goes to my, the inner, sports self. So sportsmen are usually very energetic and athletic, and I
Yep.
think that comes out very, very. Sometimes it comes out very strongly also, but I think it comes from a good place. So again, the surprising thing is, the interactions are driven by that, that athletic soul that I have, so to speak.
One book you'd recommend reading.
Currently, I think I'm rereading. Actually, I'm rereading a book, which I actually loved, when I read it long back. And this is called Zero to One. It's kind of, taking the next leap, from being where you are, to take a very quantum leap. By Peter Thiel. I think, I read that long back, and I'm rereading it. I actually just started that, last week. So I would strongly recommend for anybody who's wanting to set up their own firm, or who's wanting to sort of working in a startup environment. And I think it's very timely considering what's happening in the market with regards to AI setups, etc. So yeah, I would strongly encourage the users, to read the books. Still very, very relevant.
Most exciting part of your job.
Is interacting, conversations like these, talking to our clients. I think I loved it, so I really love, I actually love in person better, but I think considering
We all do.
we all do, right? So, but I think I love interacting, with clients, other stakeholders within the market, just interacting with people. The best part of my job, I believe, is getting immersed in sort of really and appreciative of the cultural diversity that we have. I think, right, within our clients. So I really love that, and understanding their perspective and where they come from. And we work with like global clients, so it's really, really phenomenal, and I really, really enjoy that.
And then final question is one prediction for the next 12 months.
Oh, one prediction that's going to be super easy. Look, the market is going to continue to grow, no matter what happens. I think the initial, hiccups, etc. I strongly feel that the overall credit markets are going to continue to grow strongly. The second prediction, also, I think I would say is, look, the world is going to look slightly different. AI is going to come in, and there'll be
Yeah.
some hopefully more settled down in terms of like the approaches, etc. But this survey, as I said, I think, right, survey was also an eye opener for us, with regards to the AI answers that the institutions, gave us. And I feel, look, when we talk, maybe hopefully in a year's time, Todd,
Yeah.
we'll have more clarity on, what AI is doing, and then we can pick up the morality question.
I think that's a good place to end it, Kanav. Thank you very much for your time. Really, really appreciate it. And obviously, continued success to you and the team.
Thank you so much, Todd, for having me. It was lovely, and to talk to you. And congratulations to your son on the first home run.
Thank you very much.
Cheers, man. Take care. Thank you so much.
Cheers. Thank you.
Bye.
Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.